Welcome everyone. Taking the rhythm of Friday webinars ahead and in the chase of alpha focused funds. Today we have Anirudh Garg, who is managing partner with INVasset. Over the last 5 years, Anirudh, we have been doing every Friday diligently these webinars to not only explore some of the alpha focused funds, for all our clients and all the entire community, who kind of like our webinars, and also, to bring at various times, various thought leaders with various perspectives on markets, because markets, as you know, the equity as a main asset class is always uncertain. Today at this juncture, we know there is a lot of euphoria, but valuations are also high. Last 4 years we have seen a consistent rally in the markets. And if I was to kind of talk to any fund manager, there are various views. Some see, this market as expensive and they have stopped taking money, and they are like very openly talking about it for last 6 months, and they're boasting about it that markets are absolutely in a abnormal zone and hence we have stopped taking money. But at the same time, there are many fund managers who are very confident, who are like, loyal to India as an economy, and they are seeing future and they are saying India is headed somewhere else, and hence absolutely valuations may have been high, but one has to have a long term horizon. But I know, you follow quant, so your views are not, biased, and that is what kind of makes it very unique and different. And that is where I'm equally keen, along with all of us, who are today attending this webinar, to know what are the perspectives, what is the view. I know it's very strange that when I talk to you, when I meet you, every time you say, Kamal, I have a clear view. This is something which is very unique. I never hear any fund manager saying so confidently. So I first want to understand from you, is the view clear? Is the view hazy? And what is the view?
Thank you, Kamal, for having me. It's indeed a pleasure to be at PMSA World every time. Thanks so much. Yes, I think, Kamal, the view is absolutely clear from here. I have a habit of saying that, but it rests on the research and the time we put in with the markets and the experience that we've gained over the past 3 decades. So the view currently, Kamal, is that this is, as I've been talking for the last 2 years, we are in an old economy run, which is focusing on value. And when we say we focus on value, there are two main branches of equity markets that value focuses on. It's either interest rate sensitives or the capex and capex oriented themes, the investment oriented themes. So if let's answer your question in the last on how it has played out in the last couple of years. Let's start it from the COVID period. In the COVID period, there was a shutdown everywhere. We know that it was something that the world had not seen before. At least 4 generations before us had not seen before. The last event that happened was somewhere in the 1920s. So, as the central bank of the world, the US Fed printed a lot of money that pulled us out of the COVID problems that were there. And since the US Fed was printing money, the markets saw an abnormal rise. We saw the rally which nobody had expected altogether. Post that, the US Fed said in the 2021 end that we are having inflation problems. That inflation, I still remember analysts going out and extrapolating the extraordinary earnings of Tata Steel and predicting the value of the company for the next 10 years. But when the US Fed said that there is a problem, there is a problem right away. We have seen from there that none of the metals or any other sectors which were interest rate sensitive performing really nicely. Now the US Fed signaled that we have inflation under control, and everybody started focusing on when the rate cut would come. The markets are very, very, forward looking. They discount the next 2 to 3 years of events and earnings very quickly. So that is what exactly happened. The metal stocks, which formed a real good base with inventories depleting out, have shown a remarkable rally in the last 6 months. We predict, and this is how the commodity sector cycle plays out. We believe that the metal stocks should be good for the next couple of years as well, as they've just broken out of their all-time highs. Secondly, we believe that those sectors, metals are primarily international interest rate sensitives. Their prices are determined on an international level. While there are some interest rate sensitives which are on a domestic level, something like a real estate or autos. Yeah, they're all cyclical and domestic. Now, we believe going forward that those interest rate sensitives which are of domestic nature, along with metals, should do well, that are able to pass on the input costs without any problem to their customers. For example, the autos may not be able to do so for us, but in real estate, luxury real estate may be able to do that. Yeah, with the demand of the luxury real estate that is coming in. So value run combined with the interest rate sensitives, uh, shining because the US Fed signals that the inflation problem is not a problem anymore, and passing on the metal prices and the input prices to the customers is something that we feel will work well in the future. And the primary theme of this run, which is the capex, because it's very very simple. There's no two thoughts about it. 2013 we have 2.5 lakh crores of capex by the government. Today we have 11 lakh 11,000 crores of capex. Four sectors that these have to go to: power, infrastructure, railways, and defense. So these are the sectors we believe that going forward should also perform.
So where are we, if we say, as you follow various phases of market, behaviorally and based on valuations and macros like interest rates that you mentioned, where are we, in the current juncture? This bull run started after COVID. So what phase are we lying currently?
Okay, so currently we believe that there is no doubt that we are in an expensive market. But in this expensive market, the roadmap for the next 2 years is very clear. The roadmap is those sectors that I told you. But in an expensive market, you have to be a little bit cautious. A little bit cautious. Why? Because these old economy sectors, they have a higher beta than the new economy sectors. So the old economy sectors will have more beta than FMCG, pharma, IT, all these from all these sectors. So now if a correction comes, they are bound to correct more than a normal portfolio does when researched well. But how do you balance it? How are we balancing it currently? We are focusing, because we have election around the corner, and election, though we believe that the BJP government would come in, but our belief does not matter, and we are not experts in election results. What we have done currently is that we have put 50% of our portfolio in growth, so that the alpha that we are aiming for is achieved. We have placed 50% of our portfolio in quality, so that if a negative instance comes out, the capital of my client, which is very very important to me, is also protected at the same time. So the worst case scenario I was calculating today, uh, like if everything goes wrong against you, there will not be a decline of more than 15 to 20% in the portfolio. This is the guidance that we always give, and we have placed portfolio according to that. As the volatility dies down, we may enter into growth more, and if the markets they move up really sharply from here, reach a level where they become exuberant, uh, I think PMSs have a very great advantage of hedging the portfolios. As the VIX dies down, I believe long term portfolio options would be available at a very great price. I think the main purpose of options is not trading that is going on in the markets, but to protect your portfolios, to hedge your portfolios. We may be doing that in the future, but that is a distant call from here.
Sure. So, your AUMs have grown to 300 crores already, as I see, you have crossed very recently. Over this journey, I'm sure, you would have had few learnings, because managing as you grow more and more clients tells you that you may not be only, wanting to manage money purely as a fund manager wants to do, but also you have to manage clients' emotions, because clients see index rising and the strategies like yours are index agnostic. So how do you balance out, both of these aspects? Because I see, for example, 3 months ago, when you exited from, some of the PSU stocks and moved money to diversified portfolio of large caps, portfolio was underperforming, and then suddenly you again had to change. Obviously, some of the signals from AI would have given you those ideas, but at the same time, I also see this, because there was a rally that was happening at the index level, but you may be feeling a heat from your team or from your clients, and that motivated you to do that. So how did it all work? Because we are here wanting to understand very real things, that how actually it is working, because all these clients ultimately would want to remain invested for very long term, but they need to be aware in this journey, because you are creating something new. Investors are aware of many of the other styles of investment, so they need to be 100% sure that what is happening is in line with their expectations. Hence I want you to please give all the absolute true answers, because at the end of the day,
Absolutely.
money management is also difficult work, right? So you have to manage emotions, you have to be competitive in your approach, you have to generate alpha, and alpha is like difficult. You already have generated great returns in last 1 year, you have to maintain that also. And there can be a level where you may want to see differently. Everybody else is seeing differently, you are seeing differently. So combining all these aspects, I want you to answer this question.
Okay. So, Kamal, a very valid question. I would surely like to answer it. See, uh, let me give you a brief about when a client joins INVasset. I talk to him about two things. One is the value system of INVasset. The value system of INVasset, because of the research that we had done in 2010, taught us four things. First thing was that capital is the primary thing in the market. We will earn profits for you, we may avoid losses for you, you will pay taxes, everything is going to happen in the future. The real thing today is your capital. I have seen brilliant fund managers and brilliant investors losing hope just because they have lost either their capital or their client's capital. See, once your confidence goes down, once you're out of the pitch, the entire game is finished. So first thing is protect your capital, that is the real thing. Said that, now every 3 years, if you are not able to outperform the market, then you are not fit to be a fund manager. You may look for other options. Yeah, you should go to the drawing board again. Third thing that I focus on is that a lot of fund managers or investors from time to time they create biases. ये करूंगा, ये नहीं करूंगा, I'll do just this, I'll not look at the other pocket. This is something which hampers returns a lot. Yeah. And fourth is that if we use technology, technology helps us to overcome the feelings of greed and fear. When technology takes over, when decision is based on technology, you have to improve the technology from time to time, but there's something comes between you and the decision making process, so that it is not just the fund managers are also human beings, right? They can be wrong, but if there is a guiding force, if there is a way which tells you on the pitch that which ball to medal and which to not, you are able to take a better decision. So this was the value system. The second thing is that when somebody joins INVasset, I tell them that, see, the Nifty would has historically grown 10, 20, 15 years, has grown at 12 to 14%. We aim the target, that no guarantees, but the target that we set for ourselves is 1.5 to 2x of that. That is 18, 12 ka 1.5 is 18 and 14 ka 2 is 28. So a range of 18 to 28% is something that I want to focus on. Now the problem happens when the clients, they see the last year's return. They see a return of 100 something plus percent and they expect that. Yeah. The other problems happen that, Kamal, who else more than you to know that now the clients, they do not keep all their eggs in one basket. They invest with multiple PMSs, and then they're comparing the best PMS which has performed in a month to all other PMSs, right? So I think this is not the right approach. 18 to 28% is a beautiful return. Every 3 to 4 years, your money is doubled post expense, post fees. I think we should be really satisfied with that. Yeah. And let the fund manager play out a 3 year course. What I do, how I have done in the last 3 months, let me explain that. We saw the first signs of exuberance, the very early signs of exuberance in end January, when Mr. Modi was out there in the parliament talking about PSU stocks and all. Our algorithm that time was telling us that there is a degree of, I would say, exuberance in the market. That time we took a call and exited all our PSU stocks and went to the large cap arena, so that we are able to protect the capital of our clients. That time our timing was very good, and I do not take any credit in that. It was just a matter of chance, I would say, that these stocks fell to the extent of 15 to 20% on a portfolio level. And we were really applauded. When we were being applauded, I was telling everybody, I think you were also there, I was telling that it is a matter of chance. But yes, whenever our algorithm tells us, we do not shy away from taking those decisions. From those, see, a portfolio of 100 went to 80, and then from there, it's today at around 120, 130. So we joined the rally again late at 105, 110, or 110 or something, where why did we join it? We had to be confirmed. Since these are expensive markets, I would rather play a overall breakout rather than bottom fishing. I would bottom fish in a value zone, not in an expensive zone, because the capital of my clients who are joining me right now is very important. If a client sees a fall of 20% in the portfolio, his confidence is shaken. I have clients who have a total net worth of 1 crore rupees giving me 50 lakh rupees. So a lot of moral responsibility of the client's capital protection rests on me, and I'm very, very, whenever I have to choose between a high risk, high return and a medium return, low risk strategy, I would choose the latter. So yes, this is what we did. Now we are in 50% growth, 50% quality. We missed 10%. It's okay. It does not matter for me. If I That is the beauty of a PMS, that you can re-enter or exit anytime that you want, unlike mutual funds who have to give 65% of their portfolio into equity. Now going forward also, I am really sure that markets on a broader level are expensive, but there are pockets of growth which are still not recognized by the market, and and by the bigger funds and all, which I have talked recently about. We are very bullish on those pockets. Now the clients money is into growth and quality, and as I told you, if the markets they become exuberant, we may go in for, depends upon the time, are the hedging options available on a, if hedging is give options like today are available at 7%, and the total portfolio fall has to be 15, 16%, why would I pay 7% for sure? But if the same hedging option is available to me at 3%, I may not shy away from taking that decision. Yeah, otherwise I'll have to keep cash a bit. For NRI clients, our NRI clients, you're not allowed to hedge, right? Because the RBI does not permit it properly. So there we have to maintain a certain levels of cash as we go forward, and the markets they become expensive. So yes, to define this all up, currently my portfolio is 50% quality, 50% growth for my domestic clients, and the same for my NRI clients. Now, if we go forward and the markets they become exuberant, for my domestic clients, I may hedge and maintain like 10% levels of cash. That is my view right now, and I have a right to change it. For my NRI clients, I will take out 33% money from, so 16 and a half comes from growth, 16 and a half comes from this thing, the quality, and that 33% money I may keep in cash. Why? Because it is easier said than done. When a crash in the market comes, a lot of the entire horizon of seeing the market changes, and I do not want my clients to miss out on the next 2 year massive rally that we have is due in the Indian markets, 2 to 3 year massive rally that is due in the Indian markets, just because they have seen a fall and they may exit when the markets, when there is a huge drawdown in the portfolio. So you have to balance everything. I would advise, as my dear clients who trust me, to not compare INVasset with any other. Every fund manager is doing very well on their own level. Your investments in mutual funds are being managed by the best managers in India. We are doing what we know the best, and we have been doing it for the last 30 years now. So we are doing it constantly. Trust us, and we will, turn all the tables to deliver that alpha that you're looking for at INVasset.
Sure, sure. Anirudh, another thing that I want you to cover is that in your 170-point checklist that you have created, which provides you signal to take decisions, you have mentioned one very important aspect. I'm sure there are a lot of other indicators or a lot of other areas which are linked to this, which is interest rates. And today we know we are at that juncture where interest rates are high, and over time interest rates could come down, because sooner or later inflation as a problem is going to be addressed. It's already more or less been addressed in the US. and as interest rates come down, FI money will again come back. As of now, Indian market has kind of not seen a fall despite FI taking away money over last 2.5, 3 years, because
Hmm.
DI money was there to support, and DI money would continue to support, and FI money may also come back. That's the optimistic aspect from the point of view of liquidity,
Hmm.
right? From the point of view of growth in earnings, we know Indian economy is going to see an event unfolding, which is expected to be, getting unfolded in a way that the same government could kind of, continue, and the reform process will go to the next level, and hence the growth in earnings, which is like we know it's going really well, which is also going to sustain or maybe only improve. The third factor, which is valuations, because these three factors, liquidity, earnings and valuations, are the three factors which, to my knowledge, drive stock markets. The third factor, valuations, is kind of, sporadically expensive in certain areas and sporadically, inexpensive in certain areas. But this is my assessment of the market. But throughout our conversation so far, you have talked about exuberance, and you have mentioned hedging, which conveys that you are sensing something which is like a fall of 20% or 25% or maybe more. And that is the nature of equity market. And obviously, if any such fall comes, it should be seen as a opportunity, because the long term scenario remains
Absolutely.
good. So I want you to kind of tell me that when we can't see, there is no logic, there is no reason for, from the point of view of earnings or liquidity, interest rates are not going to go up, interest rates are going to come down, earnings are going to go up, they're going to come down. Why will market fall? Why do you feel that market, if it reaches a certain 10% high from these levels, you will caught it exuberance, and you will then feel that, now I need to kind of hedge it, and kind of, I see a fall from there.
See, hedge fall in the market is the nature of market. Does not matter that India, when India was going through the 2003 to 2008 phase, where the everything was much better than these, Nifty was regularly seeing after every 2.5 year a fall of 30%. You know, the fall in the market, the bull market corrections are an evident part of investing in the equity markets. If these were not there, equity would have been the only mode of investment out there. Yeah, if it the money, अगर आपको डर ही ना हो, if there is no fear that my investment can go down, everybody would just invest in equity. Yeah, so bull market corrections are an evident part, and they should be used by good investors to put in the extra surplus that they have earned over the period and again make money from there. It is just that you have to follow one rule: invest when others are not investing, be greedy when others are not, and be fearful when others are greedy. I think this rule has to be followed every time.
No, we get that. I understand. I am into markets for last more than 2 decades.
Yeah.
So obviously, character of market is being volatile, and market will fall. I understand that at some point of time, but there has to be some anticipation of some factors as per your algorithm, as per your quant. Which needs to be discussed. That why are you feeling like that? In terms of, you have discussed one factor, which is valuations of certain areas, right? Certain at the see, you yourself mentioned that your portfolio has two parts to it. One is a growth
Hmm.
part, the other is a quality part.
Hmm.
Both ultimately are equity at the
Hmm.
end of the day.
Hmm.
And you are saying 10% or maybe 5% from here, if we see a rally, market will reach a exuberant zone. What is the definition of exuberant? Because at the end of the day, we need to understand it is also possible that market may not fall,
Absolutely.
right? That's also
That is,
possible, but
see,
you are defining it as an exuberant.
hmm.
What is the meaning of exuberant?
Okay, so the meaning of exuberance is when people they start leaving their jobs to earn in the equity market only. When your friends who you were telling 2 years before to invest in the equity market now start giving you advice that you do not know how to invest, I will give you some better things. When you say, there is one common statement everywhere, Kamalji, when you say this time it's different, अरे ये different market है, ठीक है, अरे आपको 20,000 crores के इनफ्लोज नहीं दिख रहे, मार्केट में इनफ्लोज हर साल बेटर ही हो रहे हैं कमल जी, बट द करेक्शंस आर अ पार्ट ऑफ दैट, एंड it is just that the new investors who come in, अगर आपको आते ही 20 से 25% का fall दिख जाए, your confidence is shaken. There is no more significance about it. The most significance is when the big bear run comes, when the 2008 or the 2001 or the 2020 or the 93, these bear runs comes. That time you have to be very, protect your capital. But होता क्या है? It is a combination of things. First thing is valuations. Valuations बीच में reach a level where they become a little bit unsustainable and have time भी pass करना होता है and थोड़ा valuation correction आता है. Second thing is that weak hands who have exited the markets, futures में, options में, who have taken trades, credit पे who have taken money and invested, those hands need to be taken out of the market from time to time for the markets to do well. It's just a normal nature of the. And now you're talking about what event can trigger this. Sir, when the fall comes, the fall itself is an event. When the event comes, any bad news that is out there is just amplified. When there is a bull market, now we are seeing two wars happening in the world at the same time. Okay, we are seeing the massacre that's happening in Gaza and the war that is happening in Ukraine, right? So when the bull market is going, market does not care about them. The same wars, if somebody joins in the war, maybe USA joins in or something, would create a lot of a great degree of fear in the market, and the same events would be perceived as अरे इसको लेके market टूटना था. So it is the fundamental nature of the market is corrections. The reasons are just the reasons, they वो सिर्फ बहाने बन जाते हैं उस time पे to create fear from time to time.
No, absolutely. I agree with you. On a lighter note, I'm just, saying this. See, that why I'm asking this question. It's a very basic question. I know. I understand markets can correct, and maybe markets have run up, so they will come down, right? But the thing is, you are not a biased fund manager.
Absolutely.
What you are talking about is a belief, right? Belief is bias. What I'm expecting from you is the quant. What is a quant signal? Why, how is quant conveying exuberance?
Kamalji, without quant, I would not take any decision, But quant is a multi-factor model. There are multiple factors running together, PE, PB. See, these are unifactor. पहले क्या होता था? 2008 से पहले, you would say, sell at 25 PE, buy below 18, under 12, you sell your house and invest in the market. But in the next 10 years, what we saw was that under 18 PE, the markets never saw. The markets were trading at higher PE only. So you have to make a multi-factor model. When the multi-factor model is out there and it is suggesting you that historically, the combination of valuation, suppose you are analyzing 30 factors in that, usme you analyze that out of these 30 factors, when 20 factors come along and tell you that the markets are exuberant, this has happened in the last 35 years, say 7 times. In those 7 times, one time the market has risen by 10%. Or your portfolio that you invest in, because हमने तो निफ्टी में इन्वेस्ट करा नहीं हुआ, your portfolio that you have invested in has risen 10%, but 6 times that portfolio has fallen 20 or to 25%. So as a fund manager who's relying on a multi-factor model, you would say that the markets are now expensive and I will shy away from taking broad calls. Now, what you can do as a fund manager, you can take it to the real extreme. Okay, let's take it to the real extreme. And what are we doing? If we talk about the current month, okay, the current month is not yet closed, so let's not talk about it. In January, we made a return of 16%, but a normal put of the Nifty is available at say 3%. So when you're earning that much, we delivered a return of 128% in last year. Out of that, अगर 3% हमने अपने investors का एक ऐसे time पे where we feel that the historical model is telling us that the markets are expensive, hedge कर भी दिया तो क्या problem है? There's no problem about it. अगर NRIs का 33% cash हमने रख लिया, so it's okay. There are chances. You have to just believe on, unifactor पे rely मत करो, multi-factor model पे you should rely, and then take a call accordingly. And when you are wrong, as we were for 10%, I believe it is okay to let go rising 10%, then suffer a loss of 20 to 25%. So when you are wrong, take a decision accordingly, and then again when the factor comes, again when your algo tells you that the markets are expensive, you again hedge your portfolio, create cash positions from time to time. It's it keeps the investor, I want my investors that when the fall comes, they should know that INVasset has protected my, not only generated returns, but protected my returns also, so that when the fall comes, they are like, okay, अब हमें invest करना है. I want to create that culture in my investor, because अगर उसका already portfolio, suppose you gave me 1 crore rupees. Okay, in the last 1 year, we made it 2 crore rupees. Now that 2 crore rupees fell and went down to 1.5 crore rupees. And I tell you, I call you, Kamalji, this is a very good time to invest. What will you tell me? That Anirudh, see, my portfolio, which I perceived that 2 crores is my wealth, has gone down by 50 lakh rupees. I am in no position to let put more money. I am not able to come out of, the effect that's had on my psyche by losing that 50 lakh rupees, though it is temporary. But had but if you say that the market fell 20%, but my portfolio fell only 10% because we had hedged our portfolio. So that time you would be very happy, and I tell you that, okay, now we have to top up our portfolio. You would be like, okay, no problem. I know that you can navigate the bad times also, and let's put in more money. It's not for INVasset. I want my clients, to buy the dips, to buy those massive corrections rather than surrendering to those corrections as the markets want you to.
Sure, absolutely, very well said, and I agree and understand you have to manage clients' behavior and emotions also at the same time, because in long term, that is how ultimately client will also be getting a good experience. That is why you are setting the expectations around 18 to 28%. So hence my subsequent question is linked to the last conversation only. You have two buckets to your portfolio. One is your proprietary portfolio, second your client's portfolio, right? And your proprietary portfolio has seen 3 decades of wealth creation, and obviously, the same is what learnings you're applying now to the public portfolio, to clients portfolio.
Absolutely.
But clients have a different evolution, they are at a different stage of evolution, and hence they may be comparing to other PMSs like you mentioned, right? You in your proprietary portfolio have a different mindset and different set of expectations. So over time both portfolios could be different, given this I would say type of management. Is that so? Or you will always have a same, whatever you will do in client's portfolio, you will do in your portfolio as well?
I'll have a similar portfolio. That is a rule that I've made for myself and for my team. I will have a similar portfolio. I believe that there is only one right way of doing things. If there is something that I'm doing for my clients, if it is right, I have to do for myself. One thing I would always say that, say, if a 10% of my portfolio I keep for testing new things, if a new idea comes, you test it historically and you test it for the next 2 years before amalgamating it into the algorithm. So 10% of my personal portfolio, I do not, something which is not tested, I never implement on the client's portfolio. So 10% of our portfolio we keep for testing the new things that are out there. Now, I've always seen that the clients have done better than me. Yeah. And this is something that my father, Mr. Rajneesh Garg, our implementation team always checks, that why the client portfolios over the last 5-7 years that we have invested have always done a little better. That is because we give the very best of what we have accumulated over time to our clients. I may underperform myself for some period, but for clients, you have to keep it the very right way, and there is only one right way of doing things. So 90% of my portfolio is always same with my clients. We are today told at INVasset that please follow the client's portfolio for your prop portfolio as well.
No, sure, absolutely. Thank you so much for being so sincere and honest, and I absolutely value that. Moving on, now let's assume that election results are out, markets have shown exuberance, markets come down, you hedge it, and then from there onwards starts the next bull run. Say after a gap of 3 months, 6 months, I'm sure you see it more clearly. I see it through you, and I also have my own way of looking at it, and I partially agree with you. And very confidently, I say that whatever you're saying makes a lot of sense. From that point onwards, when you will start to pick businesses, are you ready already in your algorithm that now which is the next cycle we'll be in, which is the next sector which will lead the subsequent bull run, based on your historical understanding of how markets come out of such phases? Because ultimately quantity is historical and history repeats.
Absolutely, yes.
Or you will be waiting for budget, or you will kind of look at it and then make a viewpoint?
Kamalji, the portfolio of my clients, even if I hedge or create cash, the remaining portion, suppose let's talk about this as an NRI session. So let's talk about the NRIs. The 66% portfolio that would remain would be according to what would happen in the next 2 years. It is not that a new portfolio would be created when a fall comes, if it comes. I feel that a fall is coming does not mean that the fall would come. Firstly, secondly, the portfolios that are here today, since I am taking my clients' money for the next 2 to 3 years, the portfolios are created for the next 2 to 3 years as well. So we are totally ready with what next 2 to 3 years have in store for our clients.
Sure. So what should we tell clients, or new clients who are coming to INVasset, what to expect in terms of churning ratio? Because generally in quantitative investing, it is said that churning is unpredictable. It should be assumed as 100% because quant can give signal at any point of time, and portfolio can go 100% in cash also, which never happens in other strategies, right? But in quant, this is what we generally tell our clients. But what is it that we should tell with regards to expectations on churn with regards to INVasset?
So for the next 2 years, let's talk about let's divide the 2 years into next 6 months. In next 6 months, if and all I feel that the markets are expensive, only when the algorithm gives us the signal. Algorithms are nothing, they are just historical learnings translated into a code. So there is no hi-fi algorithm working for INVasset. It is just our experience that is coded. So when those algorithms or codes tell us that historically on a multi-factor model it is expensive, you can expect a churn of 30 to 50%. Okay, that we may move in cash or hedge. Domestic clients is very easy. You can hedge, but for that the hedging options have to be available at a right point at a right rate. For example, you predict that the Nifty, the quant tells you that we should do it at, say, just a value at 25,000, just for an example. But the exuberance starts to come at, say, 24,000. So that time, the hedging options won't be available to you. That time, you may have to create a little bit of cash. So it depends upon when the exuberant come, at what rates it comes, and which is the best viable option out there. But be very rest assured that the portfolios are geared for the next 2 years, and we believe positively, like every fund manager does, that very good returns are to be made in the distant future. Just don't look at it on a month-to-month basis. The month-to-month comparison of two strategies, or a month-to-month expectation is wrong. I would say on a yearly basis also it's wrong. There comes a year in every 3-4 years where we may underperform, as we did in financial year 22-23, where our Nifty did 10%, we also did 10%. But for financial year 23-24, Nifty did 15-20%, and we did around 128%. So every fund manager has their own distinct style of investing. Live up to a period that we suggest. We suggest a minimum period of 3 to 4 years. Live through that period, and then decide that what the guidance was and what was actually delivered to you. That is the right way of seeing. And please do not look at 1 year returns of either INVasset. We were the best performing fund in the country for the last 1 year, and still I'm saying that please do not look at it. Look at our 3 year, 4 year since inception CAGR, and if you're satisfied with that, then consult your financial advisor before investing.
So, what is your take and view on India's economic growth policies and future ahead? In general, as an investor, you yourself, because you have a large prop book, you are managing money for investors. Now, let's keep quant aside, but let's understand
Total view.
you. What is your viewpoint and perspective? Where are we headed?
See, I think the markets right now are very, very clear. What is happening is, from 2008, the bull run that started in quality, it took quality to a level and valuation where they were unsustainable with the level of growth they had. For example, say something like a Asian Paints. When the 21 bull run ended, Asian Paints was available at 120 PE at just 12% growth. A wonderful company, everything all right, but you are not owning the company, you are owning a stock which has reached valuations where it may not perform historically on a historical basis, not perform that well. HDFC Bank, Kotak Bank were the most expensive lenders in the world. Kotak Bank was available at 6 price to book. HDFC was available at 5 price to book. Though the growth is there, but the valuations had reached levels where they were very, very expensive. Now, on the other hand, market is relative. इधर महंगा है तो कहीं कुछ और opportunity, sure shot, clarity of earnings for the next 2 to 3 years. Is the market seeing it? The market saw that clarity of earnings in old economy where the government was spending. आप खुद सोचिए, 2.5 lakh rupees being spent to 11 lakh rupees being spent going to the companies which you say अरे इन्होंने तो कभी perform नहीं किया. They did not perform because they did not have any reason to perform. Now the government spend on the capex has changed the scenario altogether. So we do believe that firstly the government, which is the spend that the government has done very nicely in the last 2 to 3 years, will yield very good results. A lot of industries would be created around these. For example, defense. Today there are say 7 players. In the next 3 years, we'll have at least 20 to 25 players. It comes same for railways. Infrastructure, we have so many players. They have not done well for the last 10 years. They should do really well. We can easily see out there is construction happening everywhere, from a road to a metro, from a tunnel to a bullet train. Okay, so the things are very, very evident. You have to choose the right stocks. A very simple thing. If you see the contracts that L&T is getting and the performance of L&T, which is like everybody knows L&T. L&T is like, those stocks that you can swear upon. So these companies were available at valuations that totally, justified them. And the third thing which I'm very, amazed sometime, that एक चीज नहीं है. Let me use a little bit of Hindi and give you an example by humor. एक बच्चा आज पैदा हुआ है, ठीक है जी. आप उसकी ग्रोथ को एक अडल्ट की ग्रोथ से कैसे नाप सकते हैं? समथिंग लाइक हाउ डिफेंस इंडस्ट्री हैड जस्ट come out, it has just the plant has just shooten out of the seed. हम उसको बोले अरे दिस इज वेरी एक्सपेंसिव. अरे उनकी अर्निंग्स तो आने दीजिए आप. This time, if you see, all the defense companies have posted 100% growth they are very expensive. Now, after 100% growth, a multiple of 70 has directly come down to 35. Now, kidhar gaya expensive. So something that is a green shoot which is happening right now, abhi shuru hua hai, and you are very, very sure that they have got orders. Okay, they can pass on all the price increases. Where will you get such good bets in the markets? I think they were available at extraordinary prices. Commodities are difficult sometimes to deal with. कि metals कब bottom out होंगे, कब inventories deplete होंगी, ये तो होंगे. But something like infrastructure, defense, railways, power, they were available at dirt cheap valuations, and I still believe there's a lot of scope for them for the next 2 to 3 years. Now, and there's a lot of murmur today about FII selling constantly. Kamalji, I think you must be having a question about it as well. How I see it as FIIs खरीदते क्या हैं? FIIs primarily because they belong to the Western world, the first world countries. They focus more on quality. Yeah, we have seen that FIIs. If we see where are the FII holdings, we'll see them in quality companies. They invest for a very long period of time. Now, quality in India is expensive and much more expensive than anywhere in the world. If it does not have tremendous growth, like something maybe in retail or soft drinks manufacturing company, a couple of companies doing really well in India. Rest others, they have high valuations but do not have the growth to support it. So FIIs have no option rather to sell in India. They are continuously selling and buying in other countries where growth is available at a cheaper price. Growth in quality is available at a cheaper price. Moreover, there are extraordinary innovative companies that have come up throughout the world, be it Meta, be it Nvidia, be it Microsoft, who are doing tremendously well and much, much better than what we call technology companies in India. I do not call companies like Infosys or TCS as technology companies. I believe that they are more of HR companies working for these bigger technological giants. So India may FIIs are selling, and I believe that they would keep selling for the next 2 years. we have seen very good returns in India, despite the fact that FIIs were selling. FIIs are selling the Nifty, the Nifty stock. 67% of Nifty rests with quality, and that is what the FIIs are selling. While just look at the next 50, the Nifty Junior, see the returns that it has delivered in the last 2 years. Why? Because it had stocks which, the value stocks, the value oriented stocks that were there. So your perspective has to be right. Har bull run mein, you have to focus on the new sector.
Sure, Anirudh. So people who are invested in these stocks and who are holding some of these, leaders of last bull run, and they are still kind of holding on because there is this belief that market is reaching exuberance, and some of these sectors like defense and all, which have participated in the recent rally of last 3-4 years, have run up beyond maybe fundamentals because they have gone up 3-4x or even more than that. And then as per again fundamentals only, out of 500 companies, maybe 250 companies are actually beyond their valuations, and only 40-50 stocks, like including HDFC Bank and all, which you also have in your portfolio now, and you are also focusing on protecting capital foremost at these levels, they kind of look attractive. So people who are invested in these companies through other popular names and maybe have been patient so far, what should they do? They should remain invested in those stocks, or they should remain kind of keep waiting on those businesses to ultimately start making money, maybe in new cycle, whereby now again, as you also mentioned, maybe some of the last discussions, that the subsequent cycle will be a quality cycle, or that is not going to happen because it's an old economy bull run, which is going to kind of survive, thrive, and maybe is going longer, because this time the kind of reforms that are happening are more linked to the broader markets. And hence, India as an economy, which is a very diversified economy, there are many sectors which are like beyond new economy, which are participating, which are linked to many government oriented decisions.
See, how I see it, that we take the support of these stocks. Why? Because the beta of these stocks is very less. So when we need to protect the portfolio of our clients, we buy these stocks. Why? Because if a fall comes, the money gets scared and it starts moving to these stocks. Why? Because they're generally very good businesses. There is no doubt that they're not good businesses. The only point is they are expensive. But on the other hand, markets have a tendency that when there is a situation of fear, money starts to flow to these stocks, and these stocks fell comparatively less because simple reason, they have less beta. If I have to talk in terms of investment and earning money from them, I am not interested at all for the next 2 to 3 years at least. So I think rather than advising clients what to do, you can take your cues automatically from here. I will not be investing in these companies for the next 2 to 3 years unless there is some very significant change, which we are not seeing to a very distant future. We believe that growth has to come from where it is happening for the last 2 years, and from here it will be more amplified. So we are not very big fans of the quality stocks that are out there.
What about IT? IT as a sector has also been subdued for, I think, now very long.
IT, pharma, FMCG, white goods, quality, private banks. For us, they are only and only, you know, the parking stations for us when we have to protect our portfolio a bit. And I think all these five things that I've told, as INVasset, we are not interested in them for the next 2 to 3 years.
Is there any, I would say, event which could happen which could change your view, or this is like more or less fundamental, and there is no such thing which can change this perspective and things can move towards?
Historically, in the last 35 years, it has never happened. Yeah, but if it happens, we have to be prepared for it. Maybe something like Modi government losing may change my view, because the other governments may come in, would not be surely coming in with a majority. But it looks very very uncertain. वो तो फिर एक hypothetical में तो कुछ भी बात करें, but हाँ, I am not seeing anything as such, because the entire job of me as a fund manager is to find it and just keep searching for it the entire day. But I'm not able to find anything which could change the view for the next 2 to 3 years.
Sure. So there are a lot of, I would say, PMSs and some mutual funds also which follow quant investing, and everybody has their own story. If, in maybe next 2 minutes, you have to differentiate yourself and kind of express that how are you different from other quant strategies? How will you kind of attempt that particular aspect?
See, first of all, I've never compared my quant with anybody else's. In terms of books, also, what I've read the very best of those which were successful managers, and my mind and my experience have the experience I've gained through them. We have gained experience through, you know, our learnings, the real time application into the stock market. And I don't think I'll be able to answer that because I frankly have never compared my strategy with anybody else's. When you know that you're doing the right thing, okay, when you know that currently the capex theme is still out there, the PE expansion has happened, the earning expansion has happened this time for the first quarter. It should happen for at least 8 to 12 more quarters historically. So you're very, very clear on it that you don't need to follow anybody else's, because when you follow somebody else, you know, you dilute your own thing. I've seen it in the past. So when you are doing the right thing, I don't think that you should follow anybody else's. If investors want to know that why INVasset and why not somebody else, I can tell you what is good about INVasset. The four values that we talked about, I think they are very, very fundamental to INVasset: capital protection, capital appreciation, non-creation of a bias, and using of technology. And second, the point I would say that we are very, very, I would say, ethical in terms of what we do. We take ethics and customer service at the very core of INVasset. I create a personal WhatsApp group for each of my investors where they can talk to me or any members of the team whenever they want, and any query that they have is answered, within the next 24 hours. This is what we aim for. And I believe just keep doing the right thing. You don't need to follow somebody else or compare yourself to somebody else. Comparison creates a lot of conflict.
Sure. Where do you invest your personal money?
In the same portfolio, exactly the same portfolio.
Sure. So, we are moving on to the final, last, I would say, 5 minutes of this webinar. It has been really pleasure, conversing with you. I think whatever I had in my mind from the point of view of all our clients whose money we have given you, and, whoever we like to talk to about INVasset, I have more or less covered that. But, I would like to tell you one thing. There are, obviously so many strategies, and what you are saying that investors should not compare you with, say, any other PMS, and they should have that kind of a long term perspective. So investors, I have been dealing with investors for the last 20 years. That doesn't happen. Investors will compare. In fact, the foremost, I would say, competition that you have is the quant mutual funds. The investors will compare, it's like, funds are also compared with PMSs. So one has to be definitely prepared for that. And the solution to that probably is a better communication from your point of view in terms of, quarterly con calls or quarterly newsletters, which are required. Like, you had to face certain challenges in the last 3 months, and you took certain decisions. Why did you take those decisions, which you have clarified today? That can be covered by way of a newsletter quarterly.
I think, Kamal, we are very, very, straightforward in all the decisions that we take. We write monthly newsletters to our clients in the groups, and every decision that we take, we communicate the entire psychology behind it to our investors through those monthly newsletters. I write them personally, and we communicate it from time to time. And I think that is the right way. When it comes to quarterly con calls, we have thought about it, and in the initial phase, we have done it also. What happens in a quarterly con call, according to me, every fund manager has a different way of looking at that. Rather than communicating the right idea, it sometimes goes haywire. So, today we are coming on platforms like yours, or some of the famous, financial channels from time to time. And what we are saying is what we are doing for our clients. So I think communication today is at a very good level. And I think clients should feel confident about it. And whenever we take a decision, just in the implementation phase, you cannot tell what you're doing. Otherwise, sometimes it is taken the other way by the clients. Sometimes they create some positions or something, which I believe is not right. Once the implementation phase is complete, we communicate everything and how we are thinking about it from time to time. I think I'll surely look onto it, but I think I'm one of the most. We give around 20 communications, more than 20 communications a month to our clients through those WhatsApp groups that we have created. You have a similar WhatsApp group for yourself as well, I suppose. So I think we'll surely talk about the quarterly con call also going on from here. But I believe coming on platforms like yours, who have a better reach uh, from just your clients who have invested with you, all those clients who want to invest with you also get a bite of what the fund manager is thinking. And Kamal, if there are some client questions who have taken out their time, let's address them. We have
Yeah, yeah, please go ahead. So I have actually read all those questions.
okay, okay.
Maybe you can, yeah, yeah. I have covered more or less, but if you think any question is not yet answered, you can take them.
Manav has asked, it seems that the strategy is very momentum driven. What happens when a new set of stocks start to lead the markets and railways, defense, etc. take a backseat? Manas, we are not at all momentum driven. Momentum is a very, very short, very, very small part of our investment strategy. We focus on relative change. As I was telling you from time to time, that we had held railways, defense, infrastructure, power from November of 2022 until January of 2024. We did not take any decision. All the stocks that we held from November 22 till January 24, we did not make a single change in our portfolio, not more than 5% where a new opportunity comes up. So not at all momentum driven. Momentum driven stocks you have to change from time to time. We do not believe in momentum trading. Secondly, these stocks that railways, defense, etc., please do not consider them as momentum. They are very, very solid companies with a lot of relative change. By relative change, I mean a lot of tailwinds behind them. So momentum, if also comes in the market, does not come for no reason. What is considered momentum today were the best performing stocks, the best capable stocks back in November 2022, and we believe they still are. Shailesh, selling a top selling at top and buying at bottom, considering all factors like capital gains, etc., it hardly makes a difference. Maximum 4%. Is it not better to sit through the drawdowns because you loss out on growth like it happened in April? Second question is that are quality stocks only from Nifty? Okay, so let me answer your first question first. You are absolutely right. That does not make a lot of sense when you time the market on totality. But Shaileji, what happens is that when you hit an exuberant level, if a portfolio falls 15 to 20% from there, as it did post we sold, a lot of people, they panic about it. So when you are managing funds, it's okay to take a breather from time to time. And yes, your capital gains points is absolutely right. We are surely considering it going forward. And second question is the quality stocks only from Nifty? No, the quality stocks that we will invest in are not only from Nifty. The current quality is only from, yes, you're right. The current quality is currently only from Nifty. Why? Because index has characteristics of, index balancing. So when you're approaching an event like this in an expensive market, buying the quality from the Nifty actually helps you to reduce the beta of our portfolio for some period of time. The minimum investment for NRIs is 50 lakhs only. How does your algorithm actually give signals or works? Can you explain? It's a long thing, Krishnavji. You can approach us through PMS AI World and we'll be happy to explain it to you. And I think now we have answered all the questions, Kamal.
For sure, really pleasure conversing with you, and thank you, Anirudh, for taking out time today. It was really pleasure and I would say insightful in terms of the entire conversation. I was quite clear about your strategy, and we are very confident when we talk about your quantitative strategy amongst our clients. And absolutely, every conversation makes it clearer. And today's one has also contributed to the same. I really wish you good luck for remaining number one strategy in years to come. I know every year may not be the best year, But as you rightly mentioned, a 3-year perspective is what clients should also keep in mind. And we also maintain the same. Over last 5.5 years of our journey, today we have reached more than 1100 crores of assets ourselves. And we are also very happy to find such credible strategies which help us take our entire discovery process ahead in terms of increasing share of wallet, because it's like very rare. Only 10 to 15% strategies generate alpha, and to discover those strategies objectively is what we do really well, and to explain those strategies very methodically is also something that we do really well. And this entire process of doing webinars and directly conversing with the founders and fund managers on ongoing basis is a kind of a step in that direction. And all that culminates ultimately into the good experience for investor, because good experience doesn't simply come with investing. It comes with investing after doing a lot of research and what we call as well informed investing, and then having a conviction after you have done the investment, which requires an ongoing interaction. And that's what I was stressing about in terms of communication, which I'm absolutely right. I'm absolutely agreeing with you that yes, your communication is excellent. Thank you so much everyone for joining today, and thank you everyone once again. Thank you, Anirudh. Thank you.